Okay, hi everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, my guest is Kim Butler. Welcome, Kim, to the podcast.
Thank you, Richard. A joy to be here.
No problem. Just before I start, I just want to put a disclaimer. This is not financial advice. It's only for education purpose only. So please do your own research before you make any decision. So with that out of the way, please, Kim, tell everybody who is Kim Butler.
Kim Butler has spent her entire lifetime working with money, starting about fourth grade when I got a milk cow. And our family milked cows by hand. We had two of them and sold the milk. And so I had a lot of money for a fourth grader and a seventh grader. And all the way into 12th grade, we did that. I put myself through a private school in the United States and really just went straight into money right after that. Banking, life insurance, my Series 7, my Series 65, dealing with all kinds of stocks, bonds, mutual funds, alternative investments, real estate in a variety of different ways. I'm in my late 50s now, and I still absolutely love helping people with their money.
When we talk about wealth management, what are we talking about?
It's an interesting word because wealth can mean so many things. But if we're just identifying material wealth, and I think, frankly, it is very important to identify emotional wealth and spiritual wealth and other types of wealth, family wealth, relationship wealth. Nevertheless, money may not be everything, yet it affects everything. And so we'll confine our discussion to monetary wealth. But then the word management is really interesting as well, because I think in the United States and in Canada, really, there's other countries as well. A lot of people understand that to manage something means you have to have a little bit of control over it and some abilities and a little bit of been there, done that in order to bring your experience to that management. And frankly, I don't know that any of those things are possible with even experienced, quote, wealth managers. Because if you go back through those three elements, control, really? We think we have control. We don't. As it relates to experience, yes, we may have had some experience, but I meet very experienced, quote, wealth managers that have come at wealth from such a different angle than the direction that I've come from. They literally have no experience on my side of the table, if you will. So that's a challenge. Nevertheless, we've got to have a sense that we are making progress with our money. And so we'll talk about that and ways to make that progress. And I'm probably going to have a little bit of a different take on this whole wealth management space because of my experience.
What is the difference between wealth management and financial planning?
So, financial planning to me is, first of all, an exercise in futility, mathematically correct, yet completely different and disconnected from our lives. So a typical financial plan is try to figure out what you want 20, 30, 40, 50 years down the road, and then work backwards mathematically to figure out what to do today. And again, it's mathematically correct, but often dead wrong because it makes so many assumptions, right? Assume an interest rate, assume a tax rate, assume contribution levels, assume all kinds of things that change. And even if you're shifting your data or you're updating your financial plan every couple of years, it really can sometimes either get you nowhere or cause a complete stalemate, or worse, lead you down a very wrong road. Wealth management to me is the asset side of our balance sheet. Maybe the debt could be mixed in as well, even the income, because those are all three very different things, and trying to get that money to grow, but then also dealing with the distribution side of life. I don't care for the word retirement. I think it's a societal construct that's frankly very damaging. Nevertheless, people build wealth in order to then spend that wealth in their later years. And so wealth management needs to include that. And last sentence in this section, it is the single hardest part of personal finance. Figuring out how to shift from asset growth or wealth building to income or wealth distribution.
Is wealth management targeted to high net worth people?
It is, and it should not be. The 22-year-old kid coming out of college, heck, the 18-year-old kid coming out of high school that has decided not to go to college, that starts his own business or, goes into the trades or whatever, they need, quote, wealth management. If you define wealth management as taking a look at your personal finances, so it's $100 a month, it still needs to grow. And so, unfortunately, in our society, wealth management usually has a $500,000 minimum or $1 million minimum or a $10 million minimum, depending on who the person is that you're talking to. And that's not good. I do think in today's world with the robo advisors and a lot of the free tools, you can get a financial plan for free on the internet. There is a little bit more of a societal space for wealth management for those that do not have large asset bases, and it's imperative. But I'm going to add a final sentence to this part, and that is that saving, the act of putting money away every single month, whether it's $1 or $10,000 a month or any other number, just fill in the zeros. It really doesn't matter. But the act of saving and putting money away every month, saving as a verb, is one of the most critical skills that people want to have and need, and yet often don't have. And that should be a part of wealth management.
We hear these stories of athletes that after when they finish their career, like 3 years later, they end up being broke. How can people who amass a great significant of income throughout the years of their working life, how can they how can I say that? How can they put their money to work so for them in the future years, they don't go broke?
Yeah. So this is true whether you're making a little bit of money per year or a lot of money per year. Dollars must be saved in the form of the verb, like putting it away, and then saved in the form of a noun, like stored, at a very conservative level. And what happens is nobody wants to talk about that. If you interview 10 wealth managers, they will all talk about the second step, right? What are we going to do to invest? But they skip over cash, liquidity, dollars for emergencies and opportunities. And so for anybody, if they will take a portion of their savings, so we all know we should be saving 15 to 20% of your income. I do have a really good solution for that because it's a very hard thing to do. But setting that aside, if they will take, let's say 5% of the 20% that they're saving, let's say they got to that level, and store it in a very, very safe account. I'm literally talking dividend paying whole life insurance companies that can store money with whole life, savings account at a bank, maybe a money market at a brokerage house, not investing, saving. If they will do that at whatever that 5% is, it doesn't matter if that's $100 a month or $1 million a month, and store that foundational wealth before they get into the fun stuff with the investment and the asset allocation and the alternative investments, the private placements, and all the cool stuff that everybody wants to talk about, they will get massively different results.
Speaking of alternative investments, most people know about the stocks, the bonds, and all that. We know we have different other classes, private equity or hedge funds. Can you talk about those classes? Let's talk about first private equity, and then we'll go into the hedge funds.
Sure. So, just like we were talking about, that's the sexy, fun stuff to talk about. And I want to restate, this is not financial advice. This is just education, information. And it's so important to understand a distinction that I think a lot of people don't learn about. And that is the line between an accredited investor and a non-accredited investor. Have you talked about that on your shows in the past?
No, not really.
Okay. So in America, and I'm not sure of the laws in Canada, but my guess is that they are similar. You have to have $1 million net worth, not including your home, in order to be an accredited investor. I'll explain that a little bit more in a minute. Or, so it's $1 million net worth, not including your home, or $200,000 of income per year if you're single, $300,000 of income per year if you're married. And those qualify you for an accredited investor. Accredited investors are able to get into the alternative investments, the private equities, the bridge loans, the hedge funds, the life settlements, the syndications easily and without fail. Whereas a non-accredited investor is going to have a hard time and probably not be able to get into a myriad of those alternative investments. There's exceptions, there's pieces and parts and little things that you can find in various places to access those types of deals. Yet that distinction is where the beginning should be. If somebody wants to talk about that, that's my first question. Are you accredited? And most people like you haven't even spoken about it. It's super common. Most people don't even know. They've never heard of the definition. Or maybe they have. And for what it's worth, there's another sort of micro aspect of that called a suitable investor that's a little bit lower. But most good investments that are alternative require $100,000 of cash to get into the investment from an accredited investor and 100 to 150,000 of liquid cash separate from the money that they're going to invest, because most of those alternative investment deals are not liquid. And they want to make sure that this person is not giving the investment their emergency money or the food money for their family or the rent or mortgage money or whatever it is. And so I have a lot of people that, yeah, I've got 100 grand. Well, do you have also 150 grand of liquid savings that's set aside so that you can actually do this deal? And I think we're going to see more and more requirements in that space, more forcefulness of actually making sure that the people have both the money to invest and the liquidity, which brings us right back to the conversation 5 minutes ago of where you're storing that liquidity and how very, very important it is.
So what's the difference between the two, hedge funds and private equity?
So I'm not going to pretend to be an expert in this space at all, but my sense of it is hedge funds tend to use a lot of leverage, and private equity is more commonly in an individual deal. So a hedge fund, right, might be in private equity, or it might be in a variety of other things. A hedge fund is a conglomeration of a whole bunch of different things all put together that a person or a team is managing for the investors. You can have hedge funds of all different types of investments. Private equity is most often in an individual company. There could be a private equity fund, in which case, again, there's somebody managing it. There's a bunch of different businesses in there, et cetera. This is where you hear the angel investing term as well. And it is, again, both of these truly, hedge funds are probably considered a little more liquid, but both of these are alternative investments, meaning they're not a stock bond or a mutual fund, although they do technically be a fund. But typically when people say mutual fund, they mean of public stocks. And furthermore, they're going to have those restrictions, timeframes on them. They typically are not liquid, and they can literally lose every penny that's invested, unfortunately. And nobody ever talks about that downside.
So what is your strategy when the economy goes down?
Great question. So I brought up whole life insurance earlier as a dividend paying product from a mutual life insurance company available in the US and Canada. And I'm not certain, but I don't think anywhere else in the world. It's a very unique product. And it is imperative that people learn about it. It is absolutely the redheaded stepchild of the financial services industry. Again, if you interview 10 people, you're not going to hear about whole life probably at all, maybe one. And it's probably going to be negative if you do hear about it. Yet these whole life insurance companies, so I'm talking about Guardian, Mass Mutual, New York Life, Sun Life of Canada, can't remember some of the other Canadian companies, have paid a dividend every single year, all through the Depression, all the way through the World Wars, all through 2008 crash, all through COVID times, all of those years. They have paid a dividend every single year. It is the safest place to store liquid money. It is a savings vehicle. It is not on the investment side, and very valuable to know about when people are seeking safe harbors for their dollars. And these mutual companies that have been around 150, 180 years, again, with that kind of 100+ year dividend paying capability, are very, very safe places to store both savings as a verb, the monthly money we should be putting away, as well as savings as a noun, the dollars that we may already have stored for emergencies or opportunities, because cash value of whole life insurance is liquid.
So it would be the same strategy when inflation is up and interest rate too?
Yes, because dividends will tend to adjust with inflation and interest rates in the economy, not in the stock market. It has nothing to do with stock market at all, but in the economy. And again, this is an centuries old product that has stood the test of time and outlived every economic bubble and bobble that we have had.
People tend to forget, like when they invest, about the fees that are when they invest, like it can have an effect on the return, but they don't calculate those things. Talk to us about that.
Yeah, it's a great question. So fees in your typical wealth manager experience are going to be 1.5%. I've seen averages as high as 2 and whatever, they could be 0.5. It doesn't really matter. There is a dollar figure that's removed from your account every single quarter or sometimes annually. And so not only do people forget about that because they think it's small, but I just did an analysis the other day. I use Truth Concepts software, full disclosure, that's my husband's company. And with the Truth Concepts calculators, we can take a look at somebody's account and look at the fees. And the amount of fees that get paid over a year is about $1 million account. The fees were about $120,000 over about a 30-year time frame. Well, not only did the 120 get removed from the million, but because the fee is paid over time, there is an opportunity cost that is associated with that fee because the fee comes out every year. Now, those dollars that are gone no longer have the opportunity to earn whatever that account is earning. The opportunity costs on those fees were about another 120,000. So we've got $250,000 removed from this $1 million account over time. They can be very, very damaging. And it's something for people to ask their wealth manager, their advisor about. How do you charge? What are your fees? Can I see the history of the fees? Now, there's value provided for those fees. There may be a financial plan done, or there may be meetings that occur. There may be connections that are made, a estate planning attorney or something outside of the monetary account that people find valuable. But many times I talk to people and they don't find any of that, nor do they find it valuable. So it's critical for people to understand what they're being charged, how they're being charged, and what value they're getting for those fees.
How can people navigate like life events like marriage, divorce, having a baby, selling a house or your business? How could they properly manage navigate that so it doesn't affect like the wealth management?
Yeah, it goes right back to what we were talking about earlier, which is cash and liquidity. And us entrepreneurial people, or those that are employees, but we really want the best out of our lives, we tend to go all in on investments and we forget the importance of that very boring, safe, secure, liquid money. Yet, when we have that emergency fund, that opportunity fund, those liquid dollars stored in a money market or a life insurance company's cash value in these policies, or in a savings account at a bank or a credit union, it gives us so much peace of mind. And so I really encourage people to store up more liquidity so that they can navigate all of those wonderful things in life and all of those challenges in life, because we're all going to have them and we don't know half of them, right? We know half of them, but we don't know the other half, the black swan events like 2020 that land in our lap that we must deal with immediately. The way to solve that is that storage of wealth that's liquid.
Talk to us about the importance of financial literacy.
Oh. So everybody talks about it, how desperately it's needed, and yet I completely disagree. It's not financial literacy we need, it's financial competency. So each person has a way that they learn. It doesn't matter if you're 5 years old or 50 years old. And so I always ask people, how do you learn best? Do you read? Do you watch? Do you listen? And I always make sure that I have information available in all three learning modalities. And there's a fourth, people that need to get their hands on things. And then they need to develop competency. And this starts at like age 3, when the kid is going to the store and wants the toy or the candy, right? And so you develop competency by learning first, which is that literacy part, but then being engaged and figuring out what is working and what isn't working for people around you, and then what works for you. Because what's a good investment for one person might not be a good investment for another person. So we've developed something called Prosperity Parents, and it is a course that people can take. It's $30 a month and enables people to develop how they learn, what they need to learn, and then the competency that goes with it.
Last words in regards to everything we talked about.
Gosh, I just love the money space. And I realize that everybody else doesn't. A lot of people do, but some people don't. So it's super important that at least one person in the family is going to take responsibility for it. And if it's a divide and conquer space, which is how a lot of marriages need to work these days, great. But at least once a month, have a quick hour-long family meeting, including the little kids if they're around, age-appropriate conversation. But the two adults want to have that conversation every month so that they're on the same page. And then, as I hinted at earlier, please figure out a way to develop good savings habits. And really the best way is not to put all your income into your checking account where you pay your bills and live your life. Put all of your income into a separate account. Now, we have an app and a structure that facilitates this that we provide to our clients at no charge. Nevertheless, people can do it on their own. But it's so important, because we do live our lives out of our checking account, not to put all of our income in there.
Where can people find you on social media or the internet?
I am all over the internet. I have 11 books on Amazon. I'm on Insta, Facebook, LinkedIn, you name it. But I've made a special gift for your listeners. It's at prosperitythinkers.com/Richard. And it is a lengthy white paper. It's got pictures in it, called The 7 Phases of Prosperity. And it deals with that early adult life all the way until literally when we die, and the phases that we go through, looking at people's personal finances from a prosperity economics lens, which is very different than typical financial planning or wealth management.
All right. Thank you very much, Kim. It was nice meeting you and talking to you. On that note, everybody, thank you for taking the time to listen to the podcast, and we'll see you on the next episode. Bye.